Dear shareholders, today we published our first half results for the year 2018. A few messages from my side. Continued strong earnings growth. First half operational earnings of around 1.7 billion and an underlying net income exceeding 400 million. Second, free cash flow recovery started in the second quarter. The 2Q standalone free cash flow after interest and tax was a positive more than 150 million. We also confirm our 2018 operational earnings target and midterm outlook. In terms of macro backdrop, the currency fluctuated substantially, driven by both global developments as well as events in Turkey. Likewise, inflation came in higher than expected, with June CPI at 15.4% and July at 15.8%. Until today, the environment had, however, no significant impact on the fundamental needs of our customers, who expect a reliable energy based upon a reliable grid infrastructure, as well as high-quality services from us as their electricity supplier. We also did not change our long-term beliefs nor our tactical strategy execution. We will, however, continue to show the necessary flexibility and change course if required by market circumstances in the future. As I said a second ago, operational earnings grew to around 1.7 billion at the first half, while underlying net income came in at slightly more than 400 million. As such, year-on-year growth in the P&L continues to be substantial, however lower than at the first quarter and therefore more in line with the guidance given for the full year. Free cash flow after interest and tax is about 700 million negative in the first half, however was positive in the isolated second quarter. Therefore, the indication given at the first quarter call regarding a significant increase in the cash flow until year-end is becoming visible. Investments have also picked up and are now roughly in line with our expectations. Recently, we have also received an additional CapEx allowance from the regulator for the year 2019. The process completed faster than we expected, and thus for the year 2019, we face no relevant constraints for our grid investments. The announced gas price increase, as well as the latest tariffs, are not expected to have a meaningful impact on our business. Net debt increased versus the level we had at the first quarter. However, I would like to repeat the guidance given for the year-end, which was for a net debt around the level of the first quarter, and thus again a lower leverage versus the 2017 year-end level. And finally, we recorded around 90 million positive post-tax exceptional earnings due to two effects. First, higher June CPI, which added around 200 million post-tax to the P&L, which was then partially offset by a fine from the competition authority to the tune of 107 million post-tax. Therefore, reported net income is almost 90 million higher than underlying net income. So, to summarize again, good financials in line with our expectations and guidance given, and a confirmation of 2018 and midterm targets. Thank you very much for your interest and support, and we look forward to seeing all of you during our upcoming roadshows.